Hey everyone, welcome back to Intermediate Financial Accounting 1. In last class, we talked about what is inventory and how to calculate the cost of inventory. Let's do a brief review here. So in order to calculate the cost of inventory, we need to know both the inventory system the firm is using and the cost flow method the firm is using. Inventory system can either be perpetual or periodic. And cost flow method. So three of the most common cost flow methods are average cost, LIFO, and FIFO. First in, first out, and last in, first out. So depending on the inventory system the firm is using and the cost flow method, we have a 2x3 combination. So we make it different numbers under different of those combinations. And I want to further talk about like what is the difference, again, what is the difference between perpetual and periodic. So under the perpetual inventory system, perpetual literally it just means that the firm adjusts its inventory record perpetually and perpetually at when. So perpetually every time the firm is making a sale, the firm needs to adjust those two numbers. So adjust cost of goods sold and cost of the ending inventory every time there's a sale. So the firm is keeping a perpetual record versus periodic. Under the periodic inventory system, the firm do not adjust its inventory record perpetually every time they make a sale. Instead, they only adjust it at physical period end. So actually under the periodic inventory system, if you ask a firm how much inventory you have sold, if you ask the firm before its physical period end, the firm do not know it because the firm is not keeping record of how many inventory it has sold. So how does the firm know how many inventory it has sold? The firm do it through a physical count at the end of the financial reporting period. So we all know that the number of inventory at the beginning of the financial reporting period plus purchase minus sales equals to the number of inventory that we have at the end of the financial reporting period. And we know how many inventory we have at the beginning because we had a physical count at the end of the last financial reporting period. And we do keep record of how many inventories we have purchased. But we do not keep record of how many inventory we have sold. So how do we know this number? We know it through we count. So at the end of the financial reporting period, we go into the firm and count how many inventory we have left on hand at the end of the financial reporting period. And from this number, we can calculate how many inventories we have sold. So this is the periodic inventory system. So that we can only adjust cost of goods sold and cost of the inventory or cost of the ending inventory at physical period end. So this is how to calculate the cost of the inventory. And in today's class, we are going to talk about inventory estimation and the knower of cost or net realizable value. So up until here, so we're going to talk about it later, but up until here, everything we talked about is how to calculate the cost of the inventory. However, the numbers we reported on the firm's financial statement, on the firm's balance sheet, that inventory number, it is not just the cost of the inventory. We need to take the knower of cost or net realizable value. So we're going to talk about it in a minute. So first, let's look at inventory estimation.